We are going to speak today with Gans Subramanian, Managing Partner at Hourglass Venture Partners. And we've known Gans for a very long time. Gans has been part of the 1Mby1M program earlier on. He was just saying it was 2011 when he was part of the program. So it was right after we had launched. So welcome, Gans. It's great to see you. Looking forward to catching up.
Pleasure is mine, Shramana. Thanks for having me.
What is Hourglass Venture Partners? What are you doing? What's the investment thesis? Tell us more.
Yeah, our investment, Hourglass Venture Partners is probably a new kid in the block in the world of venture capital here in the valley. Probably we are maybe the millionth, as a figure of speech, venture fund. Our investment thesis is very simple. Find mission-driven founders and back them with the venture capital plus. We call it just capital plus go-to-market help and access to customers. And thesis
what is the size of the fund, Gans?
It's a $50 million fund.
50 million. And what size checks are you writing?
We've written checks as small as $250,000. We go up to $2 million. So that our typical range is $500,000 to $2 million is what we started with $500,000 to $1 million, but as the fund size got bigger, so we decided to increase it. So.
And what stage? How do you define when a venture is ready for your investment? What are you looking for in the venture to start writing checks?
Yeah, so pre-seed to late seed or pre-series A, that's kind of the range. But typically this is how we looked at in the venture world, right? Which stage of the company. So given my experience as an entrepreneur and my partner, we look at where they are in the journey in their product market fit. Is there a roadmap to product market fit? So we look at that, and in almost all cases, there's an early traction or maybe early product fit. But so that's the stage we invest in. So we are seeing companies, founders raising capital in Series A, but there's no real product market fit as well, right? So it's just how many rounds they've raised. For us, we look at it as, is there a product market fit? We invest earlier than they found their true product market fit.
So let me synthesize what you said. You are willing to fund companies that have not yet found product market fit, but they have some customer interest and there is a roadmap to product market fit. That is the journey that you are funding.
Absolutely. And just to add to that, in the pre-seed stage, they don't need to have necessarily a customer, but we don't look at that as a specific criteria to invest. Rather, what problem are they going after? The founder's clarity on the deep insights they have about the problem, and that could be in pre-seed, that could be seed, that could be pre-series A. So.
Okay, so what about geography? Where do you like to invest?
Predominantly US. We just made our first investment in Europe, and we made also an investment in India, but predominantly it's a US geography. But in the
all
US,
over the US or just
all over the US. All over the US.
Yeah. Okay. And let's talk about what you like to invest in terms of sectors. B2B, B2C, enterprise, mid-market. What is the sweet spot of your fund?
Yeah, so sweet spot we will find out as we go through this. Our first year in existence, 2021, we launched B2B focused. Mid-market to enterprise is how we look at, but the sectors. So we started with the thematic investment, right? We identified 7 themes, and for example, video is the new data, voice is the new user experience, no code moment, and things like that. But as we went through the first year, we made 10 investments in the year one, and but we categorize all of them, all those 7, 8 themes into 5 areas: fintech, crypto tech, health tech, and AI, ML tech, all around the digital transformation. And then the last one is the cyber tech. We have 1 or 2 companies in each of those categories. So that's how we look at. We don't want to be sector focused. We're just B2B focused. Yeah.
So double click down for us on some of your pre-seed investments.
Yeah.
And tell us more about what those companies are all about, and how did you meet them? In what stage, what state did you meet them? And what is it about those particular companies that compelled you to write those checks?
So almost all of our investments are inbound referrals from our LPs or other venture firms we work with. We have relationship with. Some of them looked at what used to be seed funds have now gotten bigger. So when they run into some of them, they look at some of those companies and say, there's something interesting about this founder and this problem, but there are quite a few things have not been figured out. So that's one type of inbound deal flow for us. And second, from our LPs, our LP demography is all operators, executives, and we don't raise money from family offices by design yet, in this fund at least. So that's our deal flow and kind of companies. But the stage is that, like I said, we look at for founders, ideas get into the conversation. There are a lot of ideas, obviously, right? What is the founder's insights about the problem, why they are best suited to invest? I mean, to go after that problem is what gets us going. And how they think about it, and are they coachable founders? Predominantly product founders, not the usual, the sales founders, right? The product founders who have deeper insights about the problem, but their thinking around go-to-market is not quite well thought out or fleshed out yet. So where they could take some help from us, and we built go-to-market channels, which we bring them for them to evaluate, validate. So for us, more than the check marks or the tick marks we look for, other the clarity of the problem, and do they have a path to get your 1 million, right? $1 million in revenue run rate in 18 months to 24 months. And what all?
So let me synthesize what you said. First and foremost is the product founder, not a sales founder or a biz dev founder. You need a technical founder solving a problem that they have deep insights about. That's who you want to invest in. A pre-seed investment is largely investing in the founder.
That's correct.
So founder with a particular insight about a problem, and then you want to see a path of how that problem gets translated into products and go-to-market fit within an 18-month period leading up to $1 million revenue. That's correct. That's the synthesis. Okay, let's do some examples, maybe 2 or 3 examples of what you have invested in that fit this bill.
Sure. So we invested in a company called CapConnect, that's actually first check we wrote. Great team. They actually, they've not built a product, but all the founders have deep insights about the problem they're solving. I think they had the first mover advantage. So they've, so CapConnect Plus is a company which is building so we call them Robin Hood for corporate bonds. So 3 founders who raise corporate bonds for large enterprises before us, CFOs and treasurers. They said this is the way this done is pretty much the last 30 years hasn't changed, and there got to be a better way to do this. and they wanted to go build a platform to democratize this, and they did not have even a strong technical founder along. So we saw the clarity the founders had, and they had the risk for them was to get their license, dealer broker license, and then we invested, and then since then that they built a great team, great company. So this is
So you
one
didn't
example.
invest in a product founder in this case. What you started off by saying is you only invest in product founders, but this is not a product founder that you invested in.
This is a product founder. To me, it's not when I say product founder, do they have a clarity of the problem they want to solve? Building product is later, right? What product they want to build to solve the problem is when I use the word product founder.
I see. So you're saying that in this case, what you invested is in the product manager who had a good understanding of the product that was going to be built, but not necessarily the mechanics of implementing that
That's correct.
solution.
That's correct.
Okay, got it.
Because
So your definition of product founder does not necessarily correlate with the technical founder.
Absolutely.
Got it. Okay. Let's do another couple of examples. Just want to, illustrate what you're saying with some more visceral understanding so that people can grasp what you are saying. Pre-seed is a very interesting stage of investment, and it is probably the least liquidity stage of investment. There aren't that many pre-seed funds, and there are not that many people who are willing to invest in first-time pre-seed founders. So that's why I want to probe deeper into what is fundable and what is not fundable.
Yeah, so I mean, the fundability goes with, you know it, and all the founders know large enough a problem and etc. Right? That's the kind of fundability problem. But the particular founders to back is all about founders, all the things we talked about. There's another company, probably it doesn't work. So in that stage, pre-seed, probably there are a couple we are in the process of investing. One is a founder in the cybersecurity space, 20 years in cybersecurity. When this whole software supply chain issues, the SolarWinds attack happened. So this founders came up with this idea. They have not built up. They're probably in their 8 weeks of existence. This is sort of incubating even in the company, sort of, right? Because the founders have a clear view of the problem, and they are technical founders, but first and foremost, do they have a clear view of the problem, and they have a path to go build a great company. They have a path to go get $100 million in revenue run rate in a $100 million company in the 24 to 36 months, and assemble a great team. So this is again a pre-seed stage, even in a very early idea, but the founder has been thinking about this and talking to us for the last 6 months, and even before they formally launched it, right? So this is a product /
So I'll weigh in a little bit on cybersecurity, entrepreneurship and investment. It has become very, very difficult to sell new cybersecurity products and get meetings even with CISOs or CIOs. And a lot of early stage VCs who are investing in cybersecurity right now are investing with the kind of build to some extent, get some validation, but then basically exit. So there's a lot of conversations happening in the cybersecurity investment world that is not looking to build $100 million in, you said $100 million in 24 to 36 months. I think that's an absurd idea.
No,
I think it happens in cybersecurity.
Value creation, right? You can get $100 million if you get to $5 million in revenue, right?
$5 million in valuation, not revenue.
No, $5 million in revenue. So you get to, they see a path to $100 million in value in the next 36 months.
Okay. So you are thinking the same way. You're thinking about building capital efficiently and getting to about $5 million in revenue in the 36 months, and then exiting into a sizable cybersecurity company.
Yeah, so it's interesting you asked this question. Like we don't want to think about the exit by design for now, right? The early days, many
you have
things.
to think about the exit. We are in 2022. This comment that we don't want to think about exit, I think, is a flawed statement, Gans, because at this point, especially in cybersecurity, you have to think about exit.
No, those outcomes is going to happen, but you don't, when you start off thinking about that and build for an investor, Shramana, that's how we believe, right? These
I think
opportunities
it's
are
a
going to
belief, Dan. It's no longer contemporary. That belief was okay when we were in 2000 and the market was a lot less crowded. Today, that belief doesn't work anymore. You have to think through exit strategy. Are you going to build with a small amount of capital for exit, or are you going to build, swing for the fences and try to build a unicorn? These are two completely different strategies.
I agree, but we want to. So our thesis is this, right? When we invest in Series B in 36 months, right? Seed to Series B is 36 months, and 2 rounds of capital in 36 months. If they can find problem, they can solve, they can build a great product and revenue. All options are on the table, right? But from the get-go, okay, we're going to build this they will get acquired. That doesn't happen either. So all going for the fence is not our strategy, but we don't want to think about with that in mind, because you can't control that anyways. So focus on the execution, help them build great company. If they find an exit, that's great.
I'll tell you why it matters.
What is that?
It matters because, where you invest, are you building for a full scalable channel, or are you building basically a product, a founder-led sales strategy where you get, some number of customers to validate that this product works and get the attention of the acquirers, and you sell out? Because, building a channel is expensive. And is that where you're going to put in some of that early, very scarce amount of money that you're raising as a founder? I think these are vital decisions. You'll find out. You're just starting being a VC. You'll find out. These are all going to be concerns that you're going to have to think through.
We think about all these things, but we also believe that the companies get acquired, get sold. Get bought, not sold. So
those are cliches, Gans. Those are cliches. Those are no longer true. I think people are being very deliberate about exactly where they're going to go with things.
Absolutely, yeah.
Okay, very good. So, but what I'm very, happy to hear is that you are looking at pre-seed, because I think the gap in the market, in the venture market, is in pre-seed. So I think you're absolutely right in identifying that, that is the place to play. It is also the highest risk part of the investment cycle, because there is very little by way of proof points and so forth. So, it's a tough part of venture capital. But, before this, huge fragmentation, segmentation that has happened in the venture business, before it used to be seed and Series A. And the seed investors, or even Series A investors, were doing what today's pre-seed investors are doing. Today's pre-seed, seed, post-seed, pre-Series A, small Series A, large Series A. There is this whole continuum, and there are different venture funds positioning against each of these different, rungs of the ladder. But that was not the case when venture capital started. Venture capital in its more immature state in the 90s, in the early 2000s, even in the late 2000s. It was still, VCs, really regular VCs, had to do what Gans is talking about doing. They had to pick very early stage fund founders. Now the game has changed. The game has also changed to an extent because the founders are bootstrapping a lot more.
Yep.
So Gans, you're very familiar with the bootstrapping way of business building. So tell me a bit about what your perspective is on founders that come to you that have bootstrapped up to a point. How are you evaluating them, and what are you looking for from those situations?
So like I said, where they are and what journey they've taken is important. Actually, it's kind of a coincidence that you bring up this particular type of an opportunity. We are actually just made an investment in a company that bootstrapped for literally bootstrapped. They raised small amount of capital a long time ago. They bootstrapped, but they're at $2 million revenue run rate. Their challenge is not there's a lot of customers, but when entrepreneurs are in the market for a long time, many investors look at this. Maybe there's a fatigue, like there's something didn't work out, right? But we look at like where the inflection point took off, and from that, what can help we can bring. Bootstrapping is great. Just that during the bootstrap phase and what kind of patterns they've seen, what they've understood, what works, what doesn't. Those are things we look for. And is there an opportunity to go help them accelerate what they found and double down on it, right? So those are things we look for. So even in this case, all the more in a bootstrapped case, it's scenarios. The founders is what we back, and if the founders, if we can back them with a good team and help them build a great team, and they can accelerate. It's about our view of what the market is. So we just made.
I think you're absolutely right. There is a bias against bootstrap companies that have been going for a while. But you're absolutely right that sometimes it takes a while to find that inflection point. There's product market fit, but there's also timing, right? So sometimes, the market is not quite ready. Maybe the founders have anticipated something earlier than the market was ready for it, and the inflection point comes later on in the continuum. So I think you're right that there are opportunities to invest in such companies where there's been a long bootstrapping phase, but the inflection point is now coming, and it is ready to take off in a bigger way. Right. Very good. Great analysis.
I wanted to add to that. So the two things we look for an invest in a company, whether the bootstrap they've been enough for a long time or a pre-seed stage, deeper insights about the problem, and then the problem they're going after, that ecosystem space is at the point of inflection. That's what we look for. So that gives us an opportunity to, and when people, the founders have been around and they bootstrap for a long period, they really figure out, I've tried all these experiments, now this works, but now if it is a market of few, that's a hard, but if there is enough sizable market to be created, then we back them, and we'd love to talk to bootstrap founders. So if you have somebody, send it to us.
So. Okay, I'm sure. Very good. Very good. This is an excellent discussion. Folks, you're getting a good, nuanced perspective, and it's very comfortable for me to talk with Gans because, he knows the 1Mby1M methodology, he has used it, and so on. So it's, we have the vocabulary that we can kind of work with in diving down into the details of how pre-seed funding happens and all these nuances of bootstrapping and so forth. So very good, Gans. Thank you.